President Trump's new tariff policy is set to introduce a baseline 10% tariff on all imports, with additional country-specific rates that are significantly higher for key trading partners. These tariffs are designed to address the U.S. trade deficit with countries like China, India, and the European Union. Sarah Bianchi, chief strategist at Evercore ISI, noted that these new tariffs could push the U.S. effective weighted average tariff rate to an astonishing 24%, surpassing the infamous Smoot-Hawley Tariff Act of 1930, which many economists believe contributed to the Great Depression. This means that businesses importing goods from overseas will face significantly higher costs, which could lead to price hikes for consumers. But why is this happening now? Trump and Treasury Secretary Scott Bessent argue that these tariffs will incentivize companies to move production back to the United States, thereby creating more domestic jobs and reducing dependence on foreign economies. However, critics warn that this could lead to severe economic consequences. Several top economists are sounding the alarm. J.P. Morgan's chief U.S. economist Michael Feroli calculated that these tariffs would push the average effective tariff rate from 10% to over 23%, with further increases expected as additional tariffs on chips, pharmaceuticals, and critical minerals are implemented. More concerning is that these tariffs could lead to retaliatory measures from major trading partners, creating a cycle of escalating trade barriers. History has shown us that aggressive tariff policies often lead to reduced global trade, economic slowdowns, and in worst-case scenarios, full-blown recessions. Nora Centovagni, a global economist at J.P. Morgan, has stated that if these tariffs remain in place for an extended period, the risk of the United States and global economy entering a recession increases significantly. Trade wars are never one-sided. When one country imposes tariffs, its trading partners often respond with their own set of tariffs and restrictions. China, one of the primary targets of these tariffs, has already hinted at retaliatory measures that could include tariffs on American goods, restrictions on United States businesses operating in China, and even selling off portions of its massive holdings of United States Treasury bonds. The European Union and other affected countries may also take action by imposing tariffs on U.S. exports, making it harder for American businesses to compete globally. This could have a particularly negative impact on industries like agriculture, technology, and automotive manufacturing. For businesses that rely on imported goods, these tariffs mean increased costs, potential supply chain disruptions, and the difficult decision of whether to absorb the costs or pass them on to consumers. Small and medium-sized enterprises, or SMEs, that depend on global supply chains may be hit hardest. Unlike large corporations with diversified production facilities, smaller companies have fewer options to mitigate cost increases. For investors, the stock market reaction has already been significant. The announcement of these tariffs has led to sharp declines in major indices, particularly in sectors heavily reliant on imports such as technology and retail. Additionally, industries that export heavily to tariff-affected countries may see reduced revenues, leading to lower earnings and potential job losses. The uncertainty surrounding the duration and scope of these tariffs is likely to contribute to increased market volatility in the coming months. Trump's tariff policy is undoubtedly one of the most aggressive trade moves in modern history. While it aims to boost domestic production, the potential fallout, higher prices, reduced trade, and economic uncertainty raises serious concerns. As businesses and investors brace for the impact, the key questions remain. How long will these tariffs last? Will trade partners retaliate aggressively? And most importantly, can the U.S. economy withstand the shock without tipping into recession? One thing is certain. The coming months will be crucial in determining whether this strategy strengthens or weakens the American economy. That's it for today's episode of Wealthy Business. If you found this video informative, don't forget to like, subscribe, and turn on notifications so you never miss an update. Leave your thoughts in the comments below. We want to hear from you. Thanks for watching, and see you in the next video.